Global Economic Overview, May 29, 2025. Key economic news of the day. United States, policy moves and market reactions. The U.S. economy experienced significant movement following multiple policy updates and economic data releases. Most notably, a federal court ruling blocked the Trump administration's extensive global tariffs, declaring them beyond presidential authority. This temporarily boosted investor confidence. Wall Street futures surged over 1.5%, with gains led by chip makers, banks, luxury goods, and auto manufacturers. The USD appreciated slightly against safe haven currencies JPY, CHF, and gold extended losses for the fourth consecutive day, indicating risk-on sentiment. The 10-year Treasury yield edged higher, while the 30-year yield remained above 5%, suggesting a moderate revival in risk appetite. Still, the White House announced plans to appeal the ruling, leaving trade policy direction uncertain. The revised Q1 GDP data showed a minus 0.3% contraction, marking the first quarterly shrinkage in 3 years. The decline was mainly due to a 41.3% surge in imports, as companies rushed to buy before tariffs kicked in, which dragged down net exports. However, consumer spending and private investment remained resilient. Fed minutes released the same day expressed concern over the dual threat of tariff-induced inflation and weakening growth. The Fed highlighted the 90-day postponement of harsh tariffs as a short-term reprieve but warned that final implementation could force a tough policy choice. Market expectations for Fed rate cuts have softened, with now less than 50 BPs expected by year-end. To Europe. Markets rebound and economic adjustments. European markets gained as the U.S. court decision boosted sentiment. The Stoxx 600 index rose 0.4%, led by auto and luxury sectors. France's CAC 40 climbed 0.8%. German Q1 GDP was revised up from 0.2% to 0.4%, outperforming the Eurozone average of 0.3%. Analysts attributed this to export front-loading before U.S. tariffs. However, they warned of likely export slowdown in Q2. The ECB is now in a difficult position, balancing slowing inflation with the risk of weaker global demand from trade tensions. To Asia. Korea eases, China protests, visa restrictions. Japan's Nikkei 225 gained nearly 2%. Driven by optimism over Nvidia's strong earnings and easing U.S. trade tensions. South Korea's central bank cut rates by 25 BPs to 2.50%, its fourth cut in the current cycle, as GDP contracted 0.2% COC and inflation fell to 2.1%. Meanwhile, China strongly condemned the U.S. decision to cancel visa appointments for Chinese students. Beijing called it ideological discrimination and warned it would damage U.S. universities and its tech sector, with international students contributing over $50 billion annually to the U.S. economy. Experts warned this move could backfire. Trump's social media posts and their market impact. Trump's use of social media has again stirred markets by the dip controversy. In early April, Trump tweeted, "Now is a great time to buy DJT," just hours before announcing a 90-day tariff suspension. Markets rallied nearly 10% that day. Critics accused him of manipulating markets for political or personal gain. Fed bashing. Trump attacked Fed Chair Powell on Truth Social, calling him a fool and demanding immediate rate cuts. He threatened to fire Powell before walking back the statement. These posts raised concerns over the Fed's independence and triggered volatility in bond and stock markets. Response to Musk's criticism. After Elon Musk warned that Trump's proposed tax on spend bill could balloon the deficit, Trump moderated his tone, suggesting openness to revisions. This calmed investors fearing runaway debt. Dodging recession fears. In March, when asked about recession risks, Trump gave no assurances. Markets panicked, with major global indices tumbling. He then flooded Truth Social with over 100 posts, none addressing the economy, prompting criticism for evading responsibility. Historical data shows that when Trump posts more than 35 tweets in a day, markets are more likely to decline. Historical context and parallels. Current developments echo several past episodes. 2018 to 2019 trade war redux. Today's tariff tension mirrors the Trump-era US-China trade war. As then, central banks like Korea's BOK are pivoting back to rate cuts to cushion economic damage. 1970s stagflation risk. Fed minutes warn that tariffs could trigger a dual rise in inflation and unemployment, recalling the stagflation period of the 1970s. Judicial checks on executive power. The court's ruling against tariffs brings to mind past judicial pushbacks, such as the 2002 WTO case against Bush's steel tariffs and court blocks of Trump's travel bans. Cold War-era academic barriers. U.S. visa restrictions on Chinese students resemble past efforts to restrict academic exchanges, which ultimately harmed U.S. competitiveness. Vol Index. JP Morgan's index quantifying Trump tweet-driven volatility shows how presidential posts can meaningfully sway markets. Keywords like China, tariffs, and rate correlate strongly with short-term swings. Thanks for listening to today's report.